All right, now switching over to our Financial 15. So I'm going to share my screen and my pad. So here we are with the Financial 15. And overall, we're talking about how to get to zero tax or as close as possible. Part 1, we talked about the Roth IRA and retirement plan. Part 2, we already talked about. We talked about taxable accounts, and we talked about that last week. And if you're just joining us now, and this is the Financial 15, what you missed was about 37 minutes of market updates, for IRA distribution rules from the Ed Slott group, and some other really clever commentary. And you can find that if you want to view it on the by finding your weekly or our weekly webinar, the same title, How to Get to Zero Tax, Part 3, Pensions. This week for the Financial 15, we're going to talk about pensions. So remember the objective here. We have John and Mary. In this example, they're 61 and 60 years old. They want to retire at 66 and 65. I'm over here. Am I hiding them? Maybe a little bit. Their current income is $160,000. They need $84,000 a year after tax, or $7,000 a month. They have $43,000 in Social Security at their full retirement age. They have some goals of buying a condo, helping their daughter with a wedding at maybe age 70. And we know what kind of investments they have. They have $1 million in an IRA. They have $350,000 in mutual funds, and that was in the taxable bucket we talked about last week. They have a 401k with no match. They have some term life insurance and some long-term care insurance. And we did an analysis for John and Mary, and it is, yes, John and Mary. So, and we determined that if John and Mary are tax efficient, and again, you can go back to the first video, the part 1, to go through this in detail. But we determined, and this is not financial planning, this is a simple side-by-side comparison, that at age 85, right here, if they took the steps to be tax efficient, as opposed to just kind of following the paradigm of tax deferred, I'm going to keep my money tax deferred. Taxes will likely be lower as I age in retirement. And I say that as the old paradigm. That is not what we believe. We believe taxes are going to be much higher in the future. But you can see the difference at age 85 to John and Mary could be $2.5 million by doing things a little differently. So just by repositioning their investments in different buckets, not spending less money, not taking more risk or anything like that, just positioning their investments in different buckets. So we went over the conversion strategy and contribution strategies of Roth. We went over funding a life insurance retirement plan for your taxable accounts, and doing contributions into Roth from the taxable accounts and the effect. And this week, we're going to talk about pensions. So pensions are great. Fewer and fewer people have pensions coming their way. But they're certainly, if you're in a government agency, you likely have a pension. Some large companies still have a pension. We have a lot of pharmaceutical companies where we live here, and there are still many pensions. We are seeing them sold off to annuity companies to help remove the liability from the large company to another large company, but an insurance company. So we are seeing that from time to time, but they offer guaranteed lifetime income, these pensions. Now, of course, there's different ways that you can receive that guaranteed lifetime income. And I talk about it here. The payment tier can be simple or complex. I've seen it kind of all over the place. The state of New Jersey, in my experience, is probably the worst. So they not only have many different ways that you can receive your pension, but they have different classes of employees. And if you happen to move among different areas within the state, you can be classified different ways. So that is probably the most complex. Or it can be very simple, where you have a single lifetime payment, a joint lifetime payment, what they call a period certain lifetime payment. That typically means that someone, if not you, so your payment would be lifetime, right? So lifetime for first person. And then if you passed in a period of time, let's just say you have a period of certain of 10 years, and you passed in 5 years. So in 5 years, you're no longer here. Someone you designate would receive the payments for the remaining 5 years to round out the 10 years. And of course, they have different dollar amounts. Usually this is the most substantial. This typically is a little less, and this can be a little less as well. So that's a decision you have to make about how your pensions are distributed. Pensions are backed by a government entity or a company who you work for. Your pension payment is based on a payout factor and is sensitive to interest rates. It can be sensitive to interest rates. And this is more, the sensitivity to interest rates is more about a lump sum. And we're going to get to that. But what happens is, let's just say you've got, a value of $1 million in your pension, and your payout factor is 4, right? That means you'd get about $40,000 for the rest of your life, as long as you're alive. If you choose a joint option, it's going to be as long as you and your spouse are alive. There have been rare circumstances where I've seen it be able to go to the next generation, but it happens. So what is this PBGC down here? The PBG is the Pension Benefit Guaranty Corporation. Think of it kind of like the FDIC for pensions. A company who has a pension pays insurance premium into the PBGC. And if that company fails and can't meet its pension obligation, or there's some other reason that pension is sent to the PBGC, then the PBGC guarantees that pension will be paid out. I've seen payments coming out of the PBGC of about 25 cents on the dollar. So your payment can be greatly reduced if your payment or your pension gets sent to the PBGC. So be aware of that. What we're talking about today, so they're kind of the basics of pensions, and they can be very, very good. Guaranteed lifetime income is a great thing, right? You can't outlive this. It helps with the planning, right? If we know that a client is getting $40,000 a year come hell or high water from the time they turn 65 until their time they're no longer here, that takes a lot of pressure out of the plan. That allows for a different investment approach, and it can be a very, very good strategy. And what I learned in the back in the day of my transition right into a tax efficient planner way back in 2012 is that the problem with pensions is that they are forever taxed. And the thing is, very few pensions these days have a cost of living adjustment. So if you have a government pension, you likely have a cost of living adjustment, but you may not. Teachers' pensions here in Pennsylvania probably haven't seen a cost of living adjustment in 20 years or more. And that's a government pension, but there has not been an increase. But certainly they are forever taxed. So as tax rates go up, less and less of your pension will be a spendable amount of money to you. So in this example, $40,000, if you're at a 10% tax rate, you're only giving up $4,000. If suddenly you're at the 40 to 45% effective tax rate, well, it's much more. So there's less money you have to spend. Couple that with inflation, it can really be an issue. So from a tax planning point of view, what are the alternatives? Tax planning. Well, figure out if you have a lump sum option in your pension. Sometimes you do, sometimes you don't. If you do, they may say, okay, let's use this $1 million. Okay, you got $1 million available to you. Now, I'll tell you, interest rate sensitivity. I saw last year while interest rates were rising, $1 million becomes $900,000. $900,000 becomes $800,000 as interest rates are going up. Why is that? Because as interest rates rose, there was less money needed to affect the same payment amount. So if in this case, the company is saying, we're going to guarantee you $40,000 a year, and that was when interest rates, let's just go back to what we saw, 2.5%, at the Fed funds rate. That's not really what they use, but let's just use that as an example. And now all of a sudden that is at 5.5%. Well, you need less money on this side to generate that same $40,000. So that's where your lump sum can be affected. But let's go back to the million. So let's just say you have $1 million lump sum, and or you get $40,000 a year, and you know that $40,000 a year is going to keep you from being in a very low tax bracket or the zero tax bracket, but it's also going to expose you to erosion of that $40,000, not just because of inflation, right? But also because of tax. Because again, if you think that you're going to come in paying 10 or 20% in tax on that $40,000, and then by the time 2030 or so comes around, you're now higher than that. And we believe that your average middle-class American is going to be the 40 to 45% effective tax rate. Then less of that $40,000 is going to be yours to spend, and more is going to go to Uncle Sam. So how do you overcome that? Well, if you have a lump sum option, you can roll that lump sum over to an IRA. Now, this is really important because you might get the wrong person on your call when you call into your HR department and say, hey, can you tell me if I have a lump sum option? Because that's your first question. Contact your pension provider and say, do I have a lump sum option? And if they say yes, say, how much is that lump sum option and at what age? Because you might be 60 years old and you may not be able to take that lump sum until you're 65 years old, even if you're not working for the company anymore. That's possible. But let's just say you're still working for the company and you plan to retire at age 65, and they say you can take $1 million projected today at age 65. And you say, that's great. Well, at the time, I'm going to want to roll that to an IRA. And they might say, okay, yes, but you'll have to pay, we have to withhold 10% tax on that. And that's red. That's a buzzer. You do not have to pay tax on a pension lump sum rollover as long as it's done correctly. It's really hard to do this incorrectly. Of course, we've seen it done, but what you do is you treat it just like a 401k rollover. But I will say this, and I've said it to people, and we still get the coaching from these organizations, and sometimes even good ones. Even with a 401k rollover, well, we have to withhold 10% on that. You do not. There is no, if you get that recommendation or that advice from somebody on the other side of the phone when you're doing a rollover from 401k or a pension rollover from your lump sum pension rollover from your provider, just ask to speak for another company or another representative. I've even had people hang up and we'll call back because that is incorrect information and you're dealing with the wrong person. So you treat it like a rollover. So the $1 million gets issued in a check made out to your IRA directly and deposited into your IRA. No, not a taxable event. Now that money lives inside of your own IRA. Now, what do you do with it? Well, you can have a planned conversion strategy. So now let's look at our